Financial Services Commentary for Tuesday, April 10th of 2018. I'm going to go over a little bit today on some, I don't know, just some stuff I've thought about over the last little while. I also want to go over the market and some of the risk that I see that I think maybe some people are overlooking. So if I was to start off today, a lot of people ask, why do I collar trade? And if I was to ask you guys that, which is kind of funny because some of you have known me for years. I see Ida there. Ida, I think we go back, probably 12 years maybe to spread trade systems. Lance, I know we go about 12 years back. David, I think we're probably 10. And Mary, I bet we're in that 10 range, maybe 9-year range, 2008, right? So that's about 10 years. Out of curiosity, why do you think I collar trade? Very good, Mary. You are correct. That's one reason. I probably have a couple reasons. So when I am wrong, I can make up some of the downward movement. And you said make up the downward movement. I put some in there, Mary, because, in all honesty, I obviously don't make every penny on the way down. So I guess there are times I have, but yes, the short answer is, so I can make up some, and I put that in there myself, some of the downward movement. We have another one. I like that one. Protect profits. And if I can add to that mod, and protect, I'm going to be, and protect my money that I have in the stock market. If I'm protecting my money, I've got to protect yours, right? I want to be protected on Facebook. I want to be protected on Visa, Disney, Apple, Baidu, Ford. I've received a compliment from someone that works with me, so I guess maybe it's kind of easy, but Michael Burton has complimented me time and time again. I don't know how you figured this out. He came from a casino floor worker, and I don't know what exactly he was, but he worked in the casino business for forever. And to see someone that cares about risk actually brought him on over to me. And as we talk daily, it's really important that he says, for all the risk that's out there, I am shocked that you trade the way you do. I'll be honest with you. I like picking up more shares of stock without having to find extra money because I can do it with long put, and I should just change it, long put, comma, short call profits. I'll be honest with you. I think it's pretty cool to be a Warren Buffett, that over a 2 or 3 year time period, I can add some shares. Next down day on Baidu, I'm adding some more shares. I'm going to pick up more shares of Baidu, and I think I can do it in everyone's accounts that have about 500 shares or more. We picked up shares of Ford. Over a 2 year period of time, we've doubled shares of Ford. Baidu's an expensive stock. It's trading up at, let's see where it finished today. Finished today at Baidu finished today at at 231.50, up $7.17. So kind of a neat one. In fact, Facebook was another one today, up $7.11. And I'm going to go through some of what I did on both of those stocks here a little bit later. But yes, I am equally as scared at losing any of my money in the market as probably most of you. But one of the main reasons I collar trade is because you are supposed to trade/invest with money you can afford to lose. And I can't afford to lose any money. I can't. I've got 6 kids. I've got obligations for a home, a wife, college is coming up. I mean, who am I kidding to think that I can afford to lose $250,000 in the stock market? It can't happen for me. I can't afford to take that kind of loss or to sit for 12 and a half or 13 years to wait for it to come back. I can't afford to do that. I'll be the first one to tell you I cannot afford to lose money in the stock market. Now, that doesn't mean things can't be down for a bit, but I cannot afford to book losses in the stock market. I can't. Just plain and simple. I've got too many kids and too many obligations that does not allow me or afford to me that luxury. So the reason why I'm bringing this up is because, in all honesty, no one knows what's going to happen in the stock market. You can't adjust your way to profitability in every single trade because I am scared. Why am I scared? I'm going to give all of this to Michael because I think Michael created all this. But if you ask me, Kevin, why are you scared? What are you talking about? It really comes down to this. Let me get all this up and out. So all information was researched and compiled by Michael Verdin, Chief Investment Officer of Hurley Investments. And he's done some amazing research, obviously, in my opinion, but my opinion counts for something, at least it does right here. As I took a peek and we looked at his research, what do you see? And I can make this a little bit bigger. What do you see looking at a chart like this? If you were to look at that chart, what would you see? What would you tell me? Volatility, yes. What else would you see, though? I'll move you guys over. There you go. It looks like it's creating a pennant or a point, right? If you take a look at the short-term trend starting from February, boy, we're coming up like this. Now, again, we've had a couple up days, but we're probably going to run into that resistance level on the downtrend somewhere around 2760. We had a great run up today, right? We take a look at our chart today. We ran up to 2656. So we're in the middle of this range, bouncing off, coming back up. But yes, of course, we'll probably kind of hit this. It might happen more in the 2720, 2740-ish range, 50-ish range maybe. Then we might head back down. So we obviously have earnings coming up, right? We have some earnings coming up that makes me think we might break out of this range, but short term, we're in a tight range that's getting tighter. If we had Bollinger Bands, they'd be contracting. If we take a peek at Michael's comments, here's a current chart of the S&P 500 futures dividend into various zones that all used to adjust the trades from a macro standpoint. Currently, we are in a bearish trend. Shorter term, if we break out of the upside, my upside target is around 2720. I'm giving it a little bit of leeway, but it is about 2720. Can definitely bounce up a little bit higher than that. If we break the 2720 level, then I'll be looking for a retest of the highs of the year at 2875. This could happen if we see quick resolution to some of the trading fears that dominated the headlines recently. With that said, what was the recent headline that dominated our stock market? What was the recent headline? Do you remember? Not tariffs. Trade wars, correct, but we did have something that soothed the markets today. And it's pretty neat because it wasn't done from any of us, right? It was yesterday. I'm sorry, it's not today. It was President, and I don't know how to say it, Xi, right? I don't know how to say it exactly. But the short answer is he de-escalated the trade war. Can't spell. De-escalated the trade war rumors and allowed no tariffs on autos. Pretty amazing because he made the first step. Now you can say, hey, if we do another 100 billion, he'll do 100 billion. We do another 100 billion, he'll do 50. But do you remember what the balance is? Import, export, the balance. Kind of interesting because the what did I say? Not the overshoot, the trade imbalance is 360 billion. But how do I write this out? But the USA buys what, 480 billion, and China reciprocates by buying 50-ish, so it's 150 actually. This has to be 510. So if we buy 510 billion, China's chips are 150 billion, right? We put some tariffs, about 50 billion on the table. Those are our chips. China put 3 billion in. We said we're going to go another 100 billion. China said, well, we'll have to match that 100 billion. But once they push all their chips in of 150 billion, there's an imbalance there of $360 billion. Could you imagine what it would do to a Chinese economy if we cut their GDP by 360, if not the full $510 billion? Now, that's never going to happen in real life. We'll never do the whole amount. But what if we took 250 billion out of the Chinese GDP? Well, Kevin, is that really a lot? The short answer is not necessarily. But we do know that that China has more debt than almost the whole world. They've got ridiculous amounts of debt. So do we. So it's a game of poker. Now, we do have a problem, though. The problem with the Chinese is that they would rather die than be dishonored. So, would they be willing to go in and would they be willing to completely destroy their economy and debt and what have you to keep their honor, to be not humiliated by a President Trump that could tweet or say the wrong thing? Of course. So there's a huge amount of risk, especially when you come to my, I should say mine, but it's not mine. When you come to the second chart here, when you look at the daily chart, we've started to breach and go into that red zone. We're starting an area that we definitely don't want to fall below. And not only that, but for crying out loud, to have earnings that are expected to be 20% better this quarter over last, oh, we set that bar ridiculously high. Yes, it can happen with tax reform. That doesn't mean that's where we're going to be, though, because the tax reform is kicking in, doesn't necessarily mean it's going to be the way that we think it is. And really, when we look at a longer term chart, we are just messing and we just missed our longer term, short term support level. Now, we do have one way down here, but I don't want to test 2200 on the S&P. But breaking the short-term support level, that could be the next one we go to. We could make a case for this 2530, but there's no real support there. There isn't. If I can go ahead and state Michael's, excuse me, I had to sneeze there. If I can state Michael's comments, I think he nails it on the head. All these potential outcomes will be driven by the fundamental story of the day. I'm a fundamental investor, but use technical triggers to adjust positions in the market will generally tell you what to do. To that end, I do believe the market has changed as central banks appear to be entering a tightening cycle, which would portend a reversal of the multiple expansion that we have witnessed for years now. To me, the real question is, will earnings growth be greater than the multiple contraction the market will experience? When the market's response, a contraction comes from twofold. It comes from raising rates, which will make borrowing more expensive, which will also constrain the consumer and the, on all intents and purposes, this expected 3% GDP. I'm not sure tax reform, since it's going to come a year from now, can contradict, that's not the word I'm looking for, can offset the higher prices, even if it's only by 1%. That'll probably move the needle on a credit card about 3.5%. And I'm not sure if that's going to be a way to if 3.5% more on our credit card or a variable rate will keep people from spending the money that they might be saving on tax reform. So it'll be interesting to see. Businesses will obviously do better, but there is some ridiculously high risk. Our dollar is getting crushed. The value of our dollar is becoming just like everybody else's money. And if we run to a basket of currencies instead of having a reserve currency anymore, things could get ugly. Any questions about what I'm talking about here? Any questions I can answer for you guys in regards to any of this? Of course. Go ahead, Lance. You wrote and you have a question, but what's your question? Okay, so let me go to that in a second. So Lance just said and just asked, why do I spend so much time looking at Forex? And it's not Forex, it's just currency exchange. Why do I spend time looking at currency or money flow, especially world money flows? Because I think that tips the world off to what's happening and where the next expansion or growth is going to be. For a while, you saw a bunch of money flow worldwide that went into emerging markets. Now that has since pulled back because that found out to be risky, as these emerging markets didn't emerge as quickly as they were supposed to. Money flows into the U.S. Treasuries from overseas tells me our Fed doesn't have to buy so much of our own debt. I follow the money flows because money usually is a precursor to where the next move is going to happen. And it's something both Michael Burton and I find very interesting, is the money flow or strength of the dollar versus other currencies usually tells us I don't want to say it tells us, it can be a predictor of a recession. So it's just some things that I look at. What do I think of the GLD, Mod? I struggle. In fact, I ran a little experiment years ago, and I got some gold coins. And everyone told me back in the day that you've got to keep it in gold. It's got to be in gold. And so, I got 5 1-ounce pure gold coins. I felt rich when I was, when it was up at 20. I wasn't up to 25, but when it was up in that 2,000 to 2,100 range, I felt rich. I felt like I was in good shape. But I found out for me to broker or exchange the gold, it could cost me as much as 8% to get it from gold into dollars. Well, if you make a lot of money, you're in good shape. If it runs up significantly, you're in good shape. If you're just holding it, there's risk of that gold disappearing. If you're paying for someone else to hold it, there's risk of your gold disappearing. I found out a bank would not take a gold coin to pay a mortgage. A bank and or a car finance company would not take a gold coin for payment on automobile. A grocery store would not take the value of the gold coin for groceries. In fact, one of them was the Golden Eagle, and he'd give me $20 for at the time it was like a $1,875 gold coin. So when you ask what I think of the GLD, gold is a store of value. It's a store of value. Whether you use gold or silver, It does offset a recession or inflation fears, but it's something to be traded. It's not necessarily, I mean, if you have a whole bunch of it, it might be really tough to exchange that for dollars, and there's no guarantee you'll get a spot price for gold or silver. But I do think trading the GLD or having a portion in the GLD, if and when things start to look bad on an inflationary measure or a recessionary measure, that is a good inverse to a lowering stock market, higher inflation, those type of things. Ma, does that answer your question? And Lance, did that answer your question? Okay, so here we go. What's happening this week? PPI and core PPI, can't spell, came in at 0.3 versus 0.2, so a little hotter than expected. And not only that, but wholesale inventories came in at 1.0 versus an estimated 1.1. So a little disappointing, right? Nothing major, just a little disappointing. We had good news. I mean, the short answer is good news from China. Facebook, Zuckerberg did well. I don't know, kind of a headline-driven market, I guess, to say the least. As I take a quick peek, no trade war, less trade war. In all honesty, I could tell you that financials and tech have been hit hard and have great bounce back potential. So just some ideas that are out there that that I think is interesting. If you ask me where we're going to go, our markets are going to go higher. We're still technically bearish. Haven't had all of our crossovers yet. Have to fight through a 50-day, but I think that can happen. Same thing with the S&P. Looks exactly like the Dow, and the Dow might be a little bit ahead of the S&P with some possible crossovers. I would still tell you, with all I haven't certain for the NASDAQ composite, but still bearish as well. Now, what I think might change this comes down to Friday. First Horizon National, JP Morgan, PNC, and the Wells Fargo. We start to hit some of the banks. And we hit banks, and then we go into a barrage of earnings next week with Bank of America on Monday. There's another big bank on Monday. I don't know if it's Citi. I forgot. But we get into the 2 weeks of banks, maybe the 2.5 weeks of banking, in which case I think that can create us to can move us towards higher higher highs would come out of earnings this quarter. But the bar is set pretty high. Someone asked if I use the tips. In accounts that have had the tips, I've used them as a hedge, but we haven't had any inflation concerns for forever. So if I look at the tips, That's not the one I'm looking at. Hold on one second. I'm going to do it through E-Trade, but give me a second to get in here. Give me a second. I'm not letting you guys see some of this for a reason. Come on. Where are we? All right. Tips. I don't have a whole lot in the tips. And it really comes down to the tight range we've been in for 6 months. 114 down to 111. I don't quite see the volatility that tells me this is going to be a very profitable venture. 115 down to 111 for a year high. If we go to 2 years, 111 up to 117, we're talking about $6. If we went to a 5-year chart, 117 to a touch on 109. So I don't see the tips being maybe a wise investment against volatility or inflation, excuse me. Well, Kevin, it just hasn't run yet. If I even went out to a 10-year chart, see if I can get it. So if I went out to a 10-year chart, we have 122 to 105 to 100. I just don't see how this is going to be a better push or a better use for me than I would do puts. I think puts will be a better hedge or value if inflation starts to hit our market. So Abraham asked a question. Abraham, let me go ahead and answer that here in just a minute. If you look at how I'm looking to trade, today I rolled down protection on Baidu and Facebook. Baidu, I rolled down for the most part 250. There were some 240s down to 230 long puts, taking in about $14 of profit. On Facebook, I did much the same thing. Facebook went from 175 down to 160. Long puts, and took off June 195 short calls for $3 of profit and paid 64 cents to buy them back. And obviously those are the two that ran up today. If I was looking at financials from Abraham, Bank of America has a huge way to run up. I still like Citigroup as best in breed. Morgan Stanley seems to be doing well. And of course, I've got my Zions Bank that I think very highly of. Those are the four that I'm in for the reasons that Bank of America has the most room to run. Citi seems to be best of the breed. Morgan Stanley seems low in valuation, and Zions Bank has a long way to run to get up to previous highs. So those would be my best purchases on financials. With that said, I would include Visa as a financial as well. So those are the ones that I would be looking at to be invested in. Any other questions? In fact, let's just go down. Any other questions about anything that we have for the week? I do have an interesting Guggenheim Investment Chief sees a recession, a 40% plunge. Mathematically, again, he is correct. But what questions do you guys have that I can answer for you in the next 10 to 15 minutes? We don't have to spend that much time, but let me turn this over to you guys. If you could ask a financial advisor anything, what would you ask them? And if you don't have anything, go ahead and type in nothing. And that's funny, Lance. I knew I could count on Lance. So Lance asks, how am I doing this year? And Lance, for the short answer is I am pretty much matching the market, but that's with a 25% loss in Baidu. And over, obviously, a 20% loss in Facebook. Visa has been sideways. We've had a 10% loss in Disney. And Apple, I'm going to say, has pretty much been sideways for us as well for the year. So with those said, been pretty neat to make up significant amounts of money in Baidu, Facebook, Visa. Disney, I'm not doing so well in on making up money. And Apple, we're just what we spend for protection. We just make a little bit, it bounces right back up. There's not much to say there as well. So, Lance, for me, it's not necessarily always a dollar figure. I've been able to add shares of Baidu to accounts. We've added some shares of Bank of America to accounts. And we're holding our own quite nicely in the first down quarter that we've had in forever. I want to say at least, 8 quarters. For the first quarter of the year. So again, for me, it all comes about protection. And if I can pick up more shares, in fact, it kind of goes on with every time question. How do I buy 1 and sell for 10? You get lucky. You get a big movement up. You add some shares, so it doesn't have to move 10. If you double your share count or add shares, even if it's just 100 shares on the 1,000, it knocks off the price having to move at least 10% back up. You knock off 10% of that movement to the upside. It doesn't have to move as far for you to break even when you're adding shares that are 100% paid for with profits from those puts and calls. Did I get your questions answered, you two? Are there any other questions I can answer for you? With that said, guys, have a great week. I'll have this guy. I'll get this posted here shortly. I also understood last week was not posted, so I will get on Dave a little bit and say, hey, what's going on? Help me out here. Dave usually does the posting for Jeffrey and myself. And as I looked, I understood that maybe last week's was not posted, so I'll find out what's going on. Looks like no other questions. Guys, you have a great night. I appreciate you being here. I look forward to talking to you again next week. Take care and have a good night. Bye-bye.